I woke up this morning worth 2 billion, 300 million, and 0 cents of luck. People love to attach stories to numbers like that. They assume it means I was born gifted, or that I worked harder than everyone else, or that somewhere along the line I stumbled into the right lottery ticket called timing. None of that is true. I'm not smarter than you. I'm not more ambitious. I didn't outwork the world. What I did, decades ago, was change the way my brain made decisions. That's it. About 50 years back, I realized I was running an outdated operating system, a mind full of shortcuts that helped me survive, but kept me from compounding wealth. So I rewired it, piece by piece, using 7 simple mental tricks. They're so simple, in fact, I could have taught them to a 12-year-old. The tragedy is, nobody teaches them. Not in school, not at home, not in business. And so most people spend their lives making financial choices with the same instincts that helped cavemen avoid tigers. Emotional, impulsive, short-term, tribal. Those instincts kept our ancestors alive. Today, they quietly keep most people broke. If you've ever worked hard and wondered why you're still stuck, this is why. You're fighting the wrong enemy. It isn't the market. It isn't bad luck. It's the architecture of your own thinking. In the next 30 minutes, I'm going to show you how wealthy people reprogram that architecture. These aren't motivational slogans or morning affirmations. They're mental mechanics, the exact thinking processes we run every single day. Fair warning, this will make you uncomfortable. You'll feel parts of your mind resist. That resistance is the sound of your brain upgrading. Most people quit there. But if you stay with me, if you push through that discomfort, you'll become one of the few who actually do. In the late 1990s, everyone I knew was getting rich from tech stocks. The air itself smelled like money. You couldn't walk into a dinner party, a golf course, or even a coffee shop without hearing someone brag about a startup that had doubled, tripled, or gone up tenfold in a few months. Secretaries, lawyers, taxi drivers, everybody suddenly had opinions about the future of the internet. They spoke about it like it was gravity, inevitable, unstoppable, a tidal wave of wealth that only fools would miss. And I, apparently, was one of those fools. I remember friends, people who had known me for decades, shaking their heads, half amused, half pitying. Charlie, you just don't get it. This is the new world. You're too old school. Some of them actually called me old man, as if discipline and skepticism had expired with rotary phones. It was tempting to believe them. Every headline, every chart, every cocktail conversation pointed in one direction. Up. Companies with no profits, no revenue, sometimes not even a real product, were trading at valuations bigger than entire industries. A few of my partners whispered that maybe we were missing out on the future. And I'll admit, for a moment I felt it. The quiet anxiety of watching the world get rich without you. That's the seductive power of FOMO. It makes reason look like cowardice. I spent weeks watching, reading, listening, trying to understand the frenzy. And finally I asked myself one simple question. The same question I ask before every investment. Do I truly understand how this business makes money? The honest answer was no. I couldn't explain how these companies would turn page views into profits, or why losing money faster than your competitors was somehow a business strategy. And because I couldn't explain it, I didn't invest. That single act, refusing to bet on what I didn't understand, made me look like an idiot for almost 2 years. While the world was celebrating overnight millionaires, I sat there holding boring old stocks and cash equivalents, watching the circus. My friends bought new houses, cars, and boats. They toasted their brilliance. I nodded politely and kept quiet. Then, one morning, the music stopped. The NASDAQ collapsed. Fortunes evaporated in weeks. I still remember the calls, the disbelief, the shame in their voices as they said, it all just disappeared. Everyone I knew who'd been getting rich was suddenly broke, except me. Not because I was brilliant, but because I wasn't stupid. That's the line that's guided me ever since. Wealth isn't about being brilliant. It's about not being stupid. Avoiding stupidity sounds boring. It doesn't sell books or excite crowds. But it's the foundation of every fortune that lasts. Over my lifetime, I've seen brilliant men destroyed by things as simple as greed, impatience, or ego. The world rewards intelligence, but it punishes the absence of restraint. Now let me tell you why this lesson cut so deep. During those years, The pressure to join the crowd wasn't just financial, it was psychological. When everyone around you is making easy money, skepticism feels like self-sabotage. You start to wonder if maybe this time really is different. But the laws of economics don't change because people get excited. Gravity doesn't care how enthusiastic you are. What saved me wasn't superior insight. It was a habit of asking dumb, basic questions. How does this make money? What happens if I'm wrong? What do I actually know here? When the answers weren't clear, I walked away. That's what I later began calling staying inside your circle of competence. I wish I could tell you that lesson stuck perfectly from then on, but I've made my share of mistakes. A few years after the dot-com crash, I learned another truth, the brutal mathematics of opportunity cost. I had an employee, a sharp young man, who proudly told me he'd just bought a new car for $20,000. He said it was a reward for working hard and saving up. I asked him, half curious, "Did you calculate what that $20,000 will cost you over time?" He looked at me, confused, so I did the math for him. At an average market return of 8%, that $20,000 becomes roughly $43,000 in 10 years, $93,000 in 20, $201,000 in 30, and $434,000 in 40. "You didn't buy a car," I told him. "You bought the right to feel poor in the future." He laughed, but it stuck with me. Every dollar you spend today is a future fortune you've quietly killed. I've seen people sabotage their financial lives, not with one big mistake, but with thousands of tiny ones, each justified as just this once. That's the invisible tax of impulse. You never see the bill until decades later, when you wonder why compounding didn't work for you. The same logic applies to investments. Most people obsess over what to buy, when to buy, and what's hot, but they ignore the cost of being wrong. I've watched people sell winning stocks too early because they couldn't stand the thought of losing the gains, and then hold their losers for years, refusing to admit they were wrong. That's loss aversion, the ego's way of turning small mistakes into big ones. I've done it myself. The market has a way of teaching humility to everyone, no matter how many zeros sit in your bank account. One time I invested $5,000 in a company I thought I understood. When it went up to $8,000, I sold immediately, patting myself on the back for being smart. The same stock went on to multiply tenfold. Later, I bought another one that dropped from 5 to 3, and I held it, convincing myself it would bounce back. It never did. I lost it all. Same brain, opposite mistakes, both driven by emotion, not logic. From then on, I learned to ask one question whenever I felt fear or greed. If I didn't already own this, would I buy it today? If the answer was no, I sold. If yes, I held. Simple, unemotional, and brutally effective. These moments, dot-com hysteria, the car story, my own trading errors, taught me something far deeper than finance. They taught me that success in investing is really success in self-control. It's a battle not of IQs, but of behavior. The market, like life, constantly tests your ability to stay rational while others lose their minds. Most people fail that test not because they lack intelligence, but because they lack a system to keep emotion out of the cockpit. That's what the 7 mental tricks are for. They're not magic formulas. They're circuit breakers. They protect you from the software bugs your brain came preloaded with: fear, greed, overconfidence, envy. They help you stay inside your circle, see opportunity cost clearly, and make peace with temporary discomfort. Once you learn to think this way, you stop swinging for brilliance and start compounding sanity. So, when people look at my net worth and ask, "How did you do it?" I tell them the truth. I didn't chase every trend. I didn't need to predict the future. I simply learned how to avoid the most common ways people destroy themselves. The trick isn't to be the smartest investor in the room. It's to be the last one left standing when everyone else burns their own house down. Looking back, that's what the dot-com bubble really taught me. It wasn't a story about technology or timing. It was a mirror reflecting human psychology, the timeless cycle of greed and fear dressed in new clothes. The players change, the tools change, but the brain doesn't. And until you learn to master that brain, you'll keep repeating the same mistakes in different costumes. The good news is you can upgrade the operating system. You can replace instinct with structure, emotion with evidence, and impulse with principle. That's what I did, one mental model at a time. And from those years, those mistakes, those temptations, those close calls. I built a framework that's kept me sane and wealthy for half a century. Here's what I learned from that, and 6 other painful lessons. 7 mental tricks that will rewire the way you think about money forever. Your brain evolved to keep you alive, not to make you rich. That single fact explains almost every financial mistake you've ever made. Nature didn't design your mind for compound interest or stock markets or balance sheets. It designed you to find berries, run from predators, and stay in good standing with your tribe. For millions of years, the humans who survived weren't the clever ones. They were the cautious, anxious, imitative ones. The ones who hesitated when others ran ahead, who copied what the tribe did, who grabbed rewards immediately rather than waiting for some distant payoff. Those instincts kept your ancestors from starving. Today, they keep you from building wealth. You are running caveman software in a digital economy. Let's look at the 3 biggest biases that sabotage you: fear and hurting, cognitive blind spots, and ego. Each one is ancient, each one feels natural, and each one quietly taxes your net worth every single day. Loss aversion is the first and most powerful bug in the human operating system. Psychological research confirms what we all feel intuitively. Losing $1,000 hurts about twice as much as gaining 1,000 feels good. Your brain literally lights up with pain when you take a loss. It registers it as a threat to survival, not just a number on a screen. So you do everything possible to avoid that pain. Sell too early, refuse to take small losses, or stay out of good opportunities because the memory of one bad experience still stings. This is why most people never get wealthy even when they have enough information to make good decisions. They can't bear the temporary discomfort of volatility. They'd rather feel safe than be right. That's the paradox of investing. Comfort is expensive. If you insist on feeling good all the time, you'll pay for it with mediocrity. Then comes the herd instinct, the evolutionary cousin of loss aversion. A few thousand years ago, being excluded from the tribe meant death. So, your brain still treats social disapproval as mortal danger. When everyone around you is buying something, your neurons scream that it must be safe. When everyone's selling, your body floods with cortisol, telling you to flee. You may think you're being rational, but you're not. You're just trying not to be the gazelle left standing alone on the plain. The market exploits this instinct perfectly. When prices rise, optimism spreads like perfume. You breathe it in without noticing. When prices fall, fear becomes contagious, and your prefrontal cortex, the rational part, shuts down. You act like everyone else because thousands of years ago, acting differently could have gotten you killed. The irony is that in markets, doing what everyone else does is precisely what kills you. The instincts that kept you alive in the wild keep you poor in the market. That's why I tell people, your biggest enemy isn't inflation, taxes, or even ignorance. It's biology. The first step toward wealth is realizing that your feelings are almost always lying to you. You can't trust them. You can only observe them, the way a scientist watches a lab rat react to stimuli. When you feel fear, don't act. When you feel euphoria, don't act. Pause, breathe, and check whether you're following reason or instinct. Wealth doesn't reward bravery or intelligence as much as it rewards emotional distance. If fear and hurting are the emotional traps, then cognitive biases are the intellectual ones. They're the mental shortcuts that let us make quick decisions. But in complex systems like markets, those shortcuts become errors that compound faster than interest itself. The first is confirmation bias, the tendency to seek evidence that proves us right and ignore what might prove us wrong. It's comforting. Once you've formed an opinion, your brain filters reality to protect your ego. You stop asking, "Is this true?" and start asking, "How can I defend this?" That's why investors fall in love with bad stocks. They stop looking for truth and start collecting reasons to justify ownership. In business, it's why failing companies double down on doomed strategies. They'd rather be consistently wrong than occasionally uncertain. Then there's the sunk cost fallacy. The idea that because you've already spent time or money on something, you must continue. It's the same instinct that keeps gamblers at the table after losing half their chips. They tell themselves, "I've come too far to quit now." What they're really saying is, "My ego can't bear to admit defeat." The market loves people like that. It feeds on their pride. Remember, the market doesn't care what price you paid or how hard you worked for your position. It only cares about what's true now. And finally, overconfidence bias. the belief that we're better than average at things we barely understand. 90% of drivers think they're above average. Most investors believe they can time the market, pick winners, and outsmart algorithms run by PhDs. It's absurd, but seductive. Confidence feels good, and the world rewards it socially, even as the market punishes it financially. The truth is, you don't get paid for being certain. You get paid for being right, and those are not the same thing. Certainty without evidence is arrogance. Humility with data is power. The smartest people I've ever met carry a mental file labeled things I might be wrong about. They check it often. The cost of being wrong once is higher than the pride of being right once. That single insight can save you millions. Because in investing, one catastrophic mistake wipes out years of small wins. Pride has a negative compounding rate. Humility has a positive one. Every time you admit uncertainty, you gain optionality, the freedom to adjust, to learn, to survive. People who can't say, "I don't know," eventually pay for that blindness in cash. So, how do you fight these biases? With structure. Rules, checklists, pre-commitments. You design systems that think clearly when your brain can't. When you know your vision narrows in euphoria, you write down rules for what to do before you feel euphoric. When you know you'll avoid information that challenges you, you build the habit of reading the opposite argument first. Rationality isn't a mood, it's architecture. If fear is the first enemy and illusion the second, the third is ego, the need to look smart, be right, and win fast. Ego is subtle. It doesn't shout, it whispers. It tells you that success is proof of superiority, that losing is failure, that other people's approval validates your intelligence. It's the part of you that wants to buy the expensive car, not because you need it, but because it tells the world you've made it. Ego turns wealth into theater. In markets, ego shows up as FOMO, the fear of missing out, and its twin, status anxiety. You see others making money and feel left behind. Their gain feels like your loss. You tell yourself you're just staying informed, but really you're benchmarking your worth against theirs. That comparison quietly hijacks your decisions. You start chasing trends, not because they make sense, but because you can't stand watching someone else win while you wait patiently. The problem is, patience doesn't perform well on social media. Nobody posts a picture of themselves holding the same stock for 10 years. They post screenshots of quick doubles. Your ego sees that and says, "Why not me?" That single question has destroyed more portfolios than any bear market ever could. Ego also makes you mistake luck for skill. When things go well, you take the credit. When they go badly, you blame the market, the Fed, or bad timing. You never pause to ask, what part of this outcome was actually my doing? That's dangerous, because it tricks you into thinking you can control what you can't. The more you attribute to skill, the more risk you take to feed that illusion. Eventually, the market humbles everyone. The only question is how expensive the lesson will be. If you need the world to agree you're smart, you'll stay broke proving it. That's the trap of ego. It keeps you performing instead of compounding. The wealthy I've met, real wealth, not social media wealth, are almost boringly detached from status games. They care about independence, not applause. They understand that freedom is the highest dividend money pays. Every decision that chases recognition costs you a piece of that freedom. Comparison is the thief of both joy and judgment. When you measure yourself against others, you start playing their game instead of your own. You stop thinking about absolute returns, how much progress you've made, and focus on relative ones, whether you're ahead or behind. The market doesn't care who's ahead, it only cares who survives. So here's the truth. Your brain wasn't built for prosperity. It was built for survival, conformity, and ego maintenance. All of which are liabilities in a world where wealth rewards patience, independence, and delayed gratification. You can't uninstall those instincts. They're hardwired. But you can build guardrails, structures of thought that override them. You start by acknowledging that feelings aren't facts. Fear doesn't mean danger. Excitement doesn't mean opportunity. Certainty doesn't mean truth. The goal isn't to stop feeling, it's to stop letting feelings vote on financial decisions. That's why I built a personal operating system made of 7 mental processes. They don't make me perfect, but they keep me less wrong. They're how I audit my own psychology before it costs me money. They remind me that emotion, bias, and ego are features of the human brain, not bugs to eliminate. But they must be managed like a wild animal, respected, observed, Never trusted. Wealth building is not about outcomes. Those are lagging indicators. It's about inputs, daily thinking patterns, repeated until they become instinct. And these 7 are the new software upgrades. When people ask me how I built wealth, I always disappoint them with the answer. They expect a clever formula, a hidden stock, a lucky break. I tell them the truth. My life changed when I learned to think differently. Specifically, when I trained my mind to stop making the same predictable mistakes that ruin most people. I didn't get smarter, I got structured. Over the decades, I built a small operating system inside my head. 7 mental tools that keep me rational when everyone else is emotional. They're not glamorous. You could write them on a napkin, but they work, and they've compounded quietly for half a century. Let me walk you through them as one story, because in reality, they aren't separate tricks at all. They're 7 gears turning the same machine. The first lesson that rewired me was what I call inversion thinking. Early in life, I kept asking, how can I win? It's a seductive question. It makes you feel active, ambitious, clever. I chased answers in books and markets, studying how to outperform everyone else. One day it occurred to me that the world was full of smart people asking that same question and failing spectacularly. They had brilliance, but not wisdom. So I flipped the question on its head and asked, how do I guarantee I don't lose? That single reversal changed my operating system forever. When you look at decisions through the lens of failure, the fog clears. You stop searching for magic bullets and start spotting landmines. If you ask, what guarantees I lose money? The answers come fast and obvious. Buying what I don't understand, chasing stories instead of fundamentals, following hot tips from people who aren't rich themselves, using debt to look smart, selling in panic, or pretending I can time the market. I wrote those down decades ago and never broke them again. Avoiding stupidity is easier than seeking brilliance. It sounds dull, but dullness is underrated. The market rewards consistency, not excitement. Most people can't stand to sit still. They equate inactivity with failure. Their biology urges them to do something, but control doesn't come from motion. It comes from clarity. The fastest way to win is often to stop losing. That realization prepared me for the second principle, what I later called the circle of competence. Knowing what you understand is power. Pretending you understand what you don't is poison. During the dot-com mania, the world looked at me like a dinosaur. Everyone around me was doubling their money in internet stocks. They told me I was missing the future. The truth was simpler. I couldn't explain how those companies would make $1. When I don't know, I admit it. That honesty saved me. I sat on my hands for 2 years, felt like an idiot, and then watched the market erase fortunes overnight. I didn't look smart afterward. I looked consistent. And consistency outlives intelligence every time. The circle of competence doesn't mean staying small. It means expanding carefully from a position of real knowledge. People think admitting ignorance is weakness. In fact, it's the foundation of rationality. Overconfidence is what kills most investors. They think a shallow familiarity equals mastery. It doesn't. If you can't explain how something works to a 10-year-old, you don't understand it well enough to risk money on it. The world constantly tempts you to play games you don't know the rules to. The wealthy aren't those who play every game. They're the ones who pick one table and stay at it long enough for the odds to bend in their favor. Once you've learned to stay in your lane, you must learn to see what your instincts hide from you, the invisible cost of every choice. That's the third piece, opportunity cost. Every dollar you touch has 2 lives, the life it lives today and the one it could live if you let it compound. Most people only see the first. They trade the future for the present and call it living. They tell themselves, I can afford this, but they never ask, should I buy it? The difference between those questions is the difference between poor and wealthy. I remember talking to a young employee years ago who had just bought a new car for $20,000. He was proud. He had saved the cash and felt responsible. I asked him, do you know what that car actually cost? He looked puzzled. So I pulled out a notepad and did the math. At 8% annual return, that $20,000 doubles roughly every 9 years. $43,010, $93,020, $200,030, over $400,040. Add a modest $200 a month for 40 years, and you end up near $500,000. I told him, you didn't buy a car, You sold your future self a small fortune. He laughed, but I could see the realization land. That's opportunity cost, the invisible price tag attached to everything you buy. The brain hates that concept because it evolved for survival, not finance. Your ancestors didn't save berries for next season. They ate them before the predators arrived. That same instinct now drives you to spend the moment you feel discomfort or desire. The market exploits that primitive wiring perfectly. The discipline to think in decades instead of weekends is what separates investors from consumers. Every time I consider a purchase, I picture the compounding curve I'm sacrificing. If the trade buys freedom, fine. If it buys only vanity, I walk away. Most of wealth is restraint in disguise. The fourth principle grew from watching how badly people handle pain. Humans fear loss twice as much as they enjoy gain. The first time I felt that imbalance, it nearly broke me. I sold a stock after a small profit because I couldn't bear the thought of it falling. Months later, I watched it multiply tenfold. The next time I held one that dropped, I refused to sell, convinced it would rebound. It didn't. I lost it all. The same brain made opposite mistakes for the same reason, ego. I wanted to feel right more than I wanted to be rational. Eventually, I learned to separate identity from decision. When I evaluate an investment now, I pretend someone else made it. Then I ask one question. If I didn't already own this, would I buy it today? If the answer is no, I sell. The price I paid doesn't matter. The market doesn't refund pride. People hold bad decisions because they're trying to get even with the universe. The universe doesn't care. Your ego is the most expensive asset you own, and trimming it is the cheapest insurance you can buy. The moment you stop defending old mistakes, you start compounding wisdom instead of regret. The fifth mental tool is probabilistic thinking. For most of human history, survival depended on quick yes or no judgments, safe or dangerous, fight or flight. That binary software still runs your life, but it doesn't fit a probabilistic world. People crave certainty. They want predictions, guarantees, prophecies. They ask, will this work? When the useful question is, what are the odds that it works, and what happens if it doesn't? Thinking in odds doesn't make you omniscient. It makes you realistic. Life is a casino where you can choose your games and your stakes, but you can't change the odds. When I consider a decision, I assign rough probabilities. Maybe this idea has a 40% chance of success with a 5-to-1 payoff. That's a good bet. Maybe another has a 90% chance but tiny upside. That's a waste of time. Wealthy people make peace with uncertainty. They don't need guarantees. They need favorable math. Broke people wait for certainty, which means they wait forever. The key is to let small edges repeat. A 51% advantage, compounded over decades, turns you into a legend. The trick is staying in the game long enough for the math to work. Our brains, however, hate ambiguity. They want clean narratives, good or bad, hero or villain. The world isn't like that. It's messy, probabilistic, indifferent. To think clearly, you must accept the discomfort of maybe. I once heard someone say that uncertainty is where truth hides. They were right. The more you can live inside that gray space, the less likely you are to panic when reality refuses to behave like your story. Probability thinking isn't glamorous, but it's liberating. It frees you from the impossible burden of always being right. The sixth principle is my guardrail against excitement, the checklist method. I've seen more money lost from enthusiasm than from ignorance. Excitement feels like clarity, but it's actually a chemical fog. When you're excited, your brain stops analyzing and starts justifying. The solution is mechanical. A simple, unchanging checklist that forces logic back into the room. Before I buy or commit to anything significant, I ask myself a set of questions I've used for half a century. Do I truly understand how this makes money? Does it have a durable competitive advantage? Are the people running it honest and competent? Is the price fair relative to value? Would I be comfortable holding it for 10 years? Could I explain it to a child? If I can't answer yes to everyone, I walk away. That routine has saved me more times than I can count. The beauty of a checklist is that it doesn't care about mood. It's emotion-proof. Every mistake I've made happened because I violated my own checklist, convincing myself that this time is different. It never is. A checklist is like a pilot's pre-flight inspection. 99% of the time, nothing goes wrong, but the 1% it saves you is the difference between landing and crashing. The goal isn't brilliance, it's survival. A good checklist turns intelligence into a repeatable process, and repetition is the mother of compounding. Finally, there is emotional detachment, the hardest trick of all. Reacting less makes you richer. Most investors don't go broke because their ideas are terrible. They go broke because they can't sit still. The market drops 10% and they panic. It rises 20 and they get greedy. They check their portfolios 5 times a day, read every headline, and let cortisol make their decisions. They tell themselves they're staying informed, but what they're really doing is feeding anxiety. Wealthy people cultivate calm. We know that volatility is the price of admission for long-term returns. Every crash I've lived through, 1973, 1987, 2000, 2008 and beyond, looked unique in the moment and identical in hindsight. The pattern never changes. Optimism, mania, collapse, despair, recovery. Each time people say, this one is different, it never is. I've learned to check my investments once a month, no more. I don't watch financial news. It's designed to keep you nervous enough to click. I don't compare my results to my friends because their goals, timelines, and risks aren't mine. Comparison distorts judgment. The point isn't to be emotionless, it's to make decisions independent of emotion. I still rebalance, still manage risk, but I do it on my schedule, not the markets. Emotional detachment doesn't mean you stop caring, it means you stop reacting. In every crash, the loudest people lose the most. The quiet ones, the ones who trust their process, end up owning what the panic sold. Time is the friend of the calm and the enemy of the impulsive. When you step back, you see that these 7 habits form one seamless philosophy. Inversion keeps you from doing stupid things. The circle of competence confines you to games you can win. Opportunity cost teaches you that spending is the silent killer of freedom. Loss aversion reminds you to amputate ego before it metastasizes. Probabilistic thinking replaces fantasy with math. The checklist method converts discipline into muscle memory. And emotional detachment lets time perform its miracle of compounding without interference. Each principle alone is useful. Together they're unstoppable. None of this requires genius. What it requires is humility. The willingness to admit that your brain is an unreliable narrator and build external systems to keep it honest. The market doesn't reward IQ, it rewards behavior. You can't control the wind, but you can trim the sails. You can't predict the economy, but you can predict your own stupidity and plan around it. I've spent a lifetime doing just that. I don't win because I'm smarter. I win because I make fewer unforced errors and allow the arithmetic of compounding to do the heavy lifting. People look at the surface, the net worth, the companies, the headlines, and think wealth is about big leaps. It isn't. It's about not drowning in small mistakes. Every day I run my mind through these same 7 gears. I avoid the stupid, stay within what I know, respect the future, cut my losses, think in probabilities, use checklists, and stay calm. That's all. And somehow, over decades, that simplicity has compounded into billions. Not because I outthought the world, but because I outbehaved it. In the long run, structure beats brilliance, discipline beats excitement, and clarity beats noise. You don't need to be extraordinary to build wealth. You just need to think a little more clearly, act a little less emotionally, and let time do what time does best. The crowd will always chase what's shiny. Let them. Your job is to keep your head while everyone else is losing theirs. That's not heroism. It's arithmetic. And arithmetic, done patiently, is the closest thing this world offers to magic. People assume wealth solves everything. They think once you have enough of it, all the noise quiets down, the worries fade, and the world finally treats you gently. It doesn't. Money only amplifies what's already there. It gives you leverage on your intelligence, your habits, and your character. If you're anxious, it magnifies the anxiety. If you're rational, it magnifies your options. I've lived long enough to see both types of people end up on opposite sides of fortune with identical bank accounts. That's why I tell anyone who will listen. If you want to build real wealth, start with what sits beneath money. There are 3 pillars that hold everything else up: health, relationships, and time. If those collapse, it doesn't matter how high you stack the dollars. Health comes first because without energy, you can't sustain discipline, financial or otherwise. Most people don't realize how physical wealth creation is. Your brain is not some detached machine running numbers in isolation. It's a biological organ that tires, falters, and misfires when you mistreat it. A foggy mind buys impulsively, sells emotionally, and calls it strategy. When you lose sleep, skip movement, or live on stimulants, you make decisions from exhaustion instead of clarity. I learned this the hard way. In my early years, I treated the body as an inconvenient container for thought. I believed if I read enough and worked longer than others, I could think my way to success. I was wrong. The quality of your ideas depends on the quality of the machine producing them. A tired body makes a foolish investor. So now I treat energy like capital. I sleep, walk, eat sanely, and protect mornings for quiet thinking. It isn't glamorous advice, but it's the bedrock of rationality. Without physical stability, no strategy survives. The second pillar is relationships. The older I get, the more I realize your mental environment is built by the people you spend time with. They set the boundaries of your ambition and the ceiling of your peace. Choose them the way you choose investments, slowly, with due diligence, and for long-term compounding. I've met plenty of rich men who spend their lives surrounded by others obsessed with status, always measuring who has the bigger house, the newer plane, the louder applause. You can't stay rational in that atmosphere. It's like trying to meditate in a casino. Envy and vanity are contagious, but spend time around people who think independently, laugh easily, and don't keep score, and you'll stay sane. The best companions are the ones uninterested in proving they're better than you. They care about ideas, integrity, and the quiet satisfaction of a well-lived life. Friendship is emotional diversification. It protects you from your own worst impulses. A few honest, rational people are worth more than 1,000 flattering ones. Over time, the character of your company compounds just like interest. Then comes time, the most misunderstood currency of all. People think the goal of money is more money, but that's just a treadmill with a prettier view. The goal is freedom. Time is what money is meant to buy, and yet most people sell all their time to chase more of it. They forget the word that defines true wealth: enough. I've watched millionaires and billionaires alike wake up every day worried about someone richer. They run on a loop of comparison that never ends. The hunger doesn't stop unless you decide it stops. To me, enough isn't resignation. It's mastery. It's the point where you shift from accumulation to application, where you use resources to live deliberately, not endlessly chase validation. The happiest people I know are those who can look at what they have and say, this is sufficient. Now, how do I use it well? Enough isn't a number. It's a state of awareness. The day you reach it, you start living instead of performing. Once those three foundations, health, relationships, and time, are steady, everything else becomes a matter of rhythm. The first rhythm is process and patience. The world rewards consistent rational behavior more than bursts of brilliance. Markets, careers, and reputations all compound on delay. The lag between effort and reward frustrates most people into quitting right before results arrive. I've seen it repeatedly. Someone plants a tree, waters it for a season, then digs it up to check if it's growing. Patience isn't waiting passively. It's continuing rational behavior when the results are invisible. Life works the same way as investing. You don't get fit by one workout, wise from one book, or wealthy from one trade. It's the compounding of small correct actions that changes everything, quietly, slowly, and irreversibly. The next rhythm is less comparison. Nothing poisons thought faster than envy. The moment you start measuring yourself against others, you surrender your peace to their scoreboard. I've seen envy destroy people more intelligent than I'll ever be. They can't stand the idea of someone else succeeding faster, so they chase recognition instead of results. That's how fortunes vanish. Comparison breeds haste, and haste breeds mistakes. I train myself to feel joy when others win, because it's the antidote to bitterness. The world doesn't run out of returns because someone else found theirs. The mind that envies cannot think clearly. A mind at peace can. Once you stop competing for validation, you become available for creativity again. It's astonishing how much smarter you feel once you stop performing. The third rhythm is simplification. The older I get, the more allergic I am to complexity. Complexity looks impressive. It wins applause. But simplicity wins longevity. The fewer decisions you make, the fewer mistakes you correct. Most misery in business and in life comes from over-engineering what should have been left alone. I make very few decisions each year, but I try to make them carefully. I strip away distractions until only essentials remain. A simple life doesn't mean a small life. It means a clear one. It means reserving energy for things that compound, learning, relationships, good judgment, and ignoring the noise that pretends to matter. Simplicity is a strategy for sanity. It's how you protect focus in a world addicted to stimulation. As I look back, I realized that money was never the destination. It was a byproduct of alignment, a side effect of thinking clearly, choosing wisely, and practicing patience over decades. The more I built those habits, the less I thought about wealth at all. Money arrived as a trailing indicator of good process. True wealth is a quiet mind, not a loud lifestyle. It's the ability to sit alone without panic, to look at your calendar and see space instead of obligation, to wake up and feel unhurried. If you ever reach that point where your needs are modest, your time is mostly your own, and your mind is calm, you'll understand something the market can't price. Peace compounds faster than capital. Rationality, in the end, isn't just a financial virtue, it's a way of living that reduces unnecessary suffering. Wealth isn't the goal. Rational peace is.